All right, greetings everyone. Welcome to Parallel Session 3, Track E. This is a session on integration or fragmentation of global banking. I'm Linda Goldberg, Federal Reserve Bank of New York. Also here on behalf of Claudia Buch from the Bundesbank. The reason that we're meeting on integration or fragmentation of global banking and have 4 great papers teed up is that there is currently an initiative underway by the International Banking Research Network. It's a collection of researchers from across close to 30 international institutions, primarily central banks. And the IBRN now has an initiative where we're asking if disruptions to trade or foreign direct investment or otherwise are, have been, will be influencing the pattern of global banking. So we teed up this session to get different perspectives with some perspective on types of regulations or types of markets, needs for global liquidity through banks and so forth. So thank you to everyone for your submissions, excellent submissions, and for your presentations today. We'll have about 25 minutes per paper. So what I'm hoping is that you present for a little over 20 minutes. We could squeeze out 28 minutes per paper, but that's if everybody's well behaved on timekeeping. So target a little over 20 minutes and hopefully we'll have some nice discussion across the session. So let's start with James Chapman on intraday liquidity around the world. James is from the Bank of Canada and he's representing a very large office. So take it away, James.
Excellent. Thanks for having me. Let me share my screen. Okay. There we go. Can everyone see that? Excellent. So thanks, Linda and organizers for allowing us to present in this session. I think this is a perfect session for this paper because I think it's very aligned with some of the work that the IBRN folks are doing. And so this is intraday liquidity around the world. Like Linda mentioned, there's a lot of co-authors. So essentially the usual disclaimer applies for all the central banks involved. So these are not necessarily the views of the CPMI, which is the coordinating body, or the participating central banks. And by participating central banks, let me see if I switch this. There we go. I think we have 14 co-authors and counting on this paper. So this is a truly cross central bank work that wouldn't have been possible without all the folks on this listed on this slide. Folks from the Federal Reserve Board of Governors, Bank of Mexico, Bank of Colombia, Bank of Canada, the Bundesbank, the ECB. UC Santa Barbara and Nottingham, the DNB, the New York Fed, Swiss National Bank, the BIS, the Danish National Bank is not here because Thomas Nilsson moved, and the ECB. So this is cross-sectional work, and really what it's all about is very similar to what, in spirit to what happens in IBRN projects, which I was lucky enough to be involved in one early on in the IBRN's existence. And what we've done here is take a similar approach to sensitive data to understand questions around liquidity in large value payment systems. So large value payment systems, if you don't know, they underpin basically all electronic transactions in a country, essentially. And they're a major use of fixed income assets because since they're systemically important, you need basically government assets as collateral to make payments in a large value payment system. And to give you a sense of magnitude, I think that the number people usually cite is the number of payments made through, say, Fedwire is about 1/5 of annualized GDP per day, right? And in Canada, I think it's roughly the same magnitude. And I think the last time I looked at the Swiss National Bank, it was like 1/3 of Swiss GDP per day. So these are very large amounts of money moving, and that means there's a large need for collateral. And since they're systemically important, they're all what's called real-time gross settlement. So that means you have to have the liquidity in your account to send a payment. So they can become very liquidity expensive. And pre-global financial crisis, there was a lot of research about how to make them more efficient. That's abated a little bit with QE and other liquidity injections in the system. But I think it's important to understand how these systems operate, because eventually we'll go back to normal and we'll go back to understanding how to make these systems efficient. And really, it's important to understand the institutional features in a system, because the participant banks behave, based their behavior on how the systems, on the institutional features of the systems, such as is there a queue or not. And in this paper is the first paper where we did this large-scale data coordination exercise to create a cross-system study of intraday liquidity usage, which allows us to look at a variation of institutional features across the central banks, across the central banking systems. So, the coordinating body for this was the Committee for Payment and Market Infrastructure, which is the equivalent of the Basel Committee for payment and financial market infrastructure. And I proposed a collaborative study from my experience in the IBRN, where the key issue in a lot of this work is it's sensitive transactional level data for payment systems. And I thought, well, if we do a la most IBRN works, where individual teams research teams inside central banks do some analysis, we can share that analysis, because it'll be useful, but it'll be less sensitive. And what we did in this group is we developed a common methodology for measuring liquidity efficiency, that is the number of payments that can be made per dollar of liquidity at a system level, at a daily system level, and along with some covariates and various other institutional features. So we constructed that data set. The group, as part of the group, we helped other central banks in the team collect and process the data, because there's a lot of data processing questions. And then because we're lucky, because the measures we created were they're sensitive, but they're not so sensitive that we can't share them among our groups. So we were able to create a panel of institutional features and market features for all these systems, and create a panel, and then do some panel regressions. And then we're publishing this research. So before I go on, I want to say as part of this measurement, and I think this is where I'm actively marketing this, is if you go to the Bank of Canada Payment Research GitHub website, or reach out to me, we have a publicly available R package called CPMI Stats that can create all these measures. And I know I've talked to central banks that are not as part of the group, and they've used these measures for internal monitoring or internal benchmarking against our results. So one of the things I'm trying to promote is sort of this harmonized data methodology, data vocabulary to talk about how systems, large value payment systems and payment systems in general perform, right? And as using this package, we created this harmonized cross-system data. That was a large undertaking, where we have about 12 years of data for 8, close to 9 central banks. So the results I'm going to present show results from Bank of Canada, the Colombian, the Danish system, Eurozone, Mexico, Switzerland, US, and UK. But recently, the Bank of Brazil has also added to our work, and our eventual working paper will have the Bank of Brazil's data as well. And to give a sense of magnitude, these payment systems underpin about 50% of global GDP. With Bank of Brazil, it'll be just a little bit over 50% of global GDP. So these are very important systems. And I'll go really quickly through the economics so that people can understand what the economic trade-off is in one of these systems. But what banks do in these systems is, they have to send payments on behalf of their clients or because of their operations, like settle security transactions. So liquidity in this system is the ability to unilaterally send a payment. So it's the amount of reserves in the central bank's bank account, or bank's central bank account, if you want. And really the question is all about coordinating these payments. So, Morton Beck and Rod Garratt, they had this JET article in 2003 that was the first to analyze this as a game. So if you think of this game, think of a game in your head. You have two banks. I'll use Linda as an example. I have to send Linda a payment. Linda has to send me a payment in the day, right? So we're payment operators at our banks. And we can send it in the morning or the afternoon. If I send it unilaterally to Linda, it's going to cost some liquidity. Why? If I wait to send it in the afternoon, I'll get a delay cost, which could be I miss a crucial payment or my client's mad at me, and that's a delay cost W. If we both send it at the same time, there's some netting that offsets our costs. That's P. And then, so if I pay in the morning and Linda pays me in the afternoon, then I pay a liquidity cost Y. So this is just a 2x2 game. And this is basically the intuition of what we're working with. In equilibrium, people are going to coordinate. They either pay in the morning or they pay in the afternoon. It's all about coordination of payments in a large value payment system. And institutional features affect that coordination, right? They use it maybe focal points. They change people's cost, change these Y's and P's and W's. And there's been a little bit of literature on this. Antoine Morton and Jamie McAndrews at the Fed sort of extended the work to think about queues. Like, so instead of me sending payment to Linda, I can put it in a queue, and it's now a conditional payment until she sends me something, and then it nets out in the queue, for example. And that's what LSMs are, liquidity savings mechanisms. So there was a lot of theory work on this in the first part of this century. And basically to say, LSMs can provide higher welfare due to increased netting opportunities. And then in addition, there's this empirical literature that works on a per payment system level. So people look at the time series properties of their systems and how individual participants behave when there's a change in the institutional features of that system. So these two strands talk about efficiency of liquidity efficiency and behavior, but they're really silent on institutional features because there's not a lot of institutional variation through the systems. And so that's what we do in this work. We measure this intraday liquidity in a consistent way across central banks, along with various determinants of intraday liquidity, like the opportunity cost of sending a payment in terms of central bank reserves or payments, or the overnight interest rate, institutional features, and the design of these things that should save liquidity, right? And when I say should save liquidity, that's a preview of the results. So, because I might likely run out of time to show all our results, I'll give a quick preview. So, first, this is the first, measure cross jurisdiction work that looks at this. And then I think there are some things that happened in the work that seem quite intuitive. Banks, which are the main participants in these systems, they respond to institutional features and the cost of liquidity, which is unsurprising. As the price of liquidity decreases, so think of the overnight rate goes down or the amount of reserves in the system go up, then liquidity efficiency decreases. So the way I think of it as, when the gas price is really low, gas price is really low, you drive all over the place. You can go long vacations, driving and stuff. When there's a gas crisis, a fuel crisis, or an oil crisis, and gas prices go up quite a bit, you start becoming quite efficient with how you are judicious with what you do with your car. It's the same sort of thing here. The efficiency of the system decreases as the opportunity cost of liquidity decreases. And another thing that's been documented in various studies before. And also, payments happen earlier in the day. That's another well-documented thing because people coordinate less on payments. A payment comes in the morning for me, I send it out right away, whereas before I might have waited until the afternoon for an offsetting payment. But I think this is the crucial thing that surprised us all. Is liquidity savings mechanisms don't save liquidity in these systems. They are not uniformly associated with increasing liquidity efficiency, and some aspects of them actually decrease liquidity efficiency, which I think is quite a spectacular result. And we did a lot of work to verify this. In terms of various specifications we used, some in the paper, some not, and it seems a very strong result that LSMs are not a panacea of these systems, which when you talk to a payment system expert, this will flabbergast them. So I'm getting, there's a lot of slides and I don't have a lot of time, so I'll give a quick overview of some of the results. So these are some of the aggregate measures we used. So, the amount of payments, all the payments made by participants in the system, the amount of reserves or credit at central bank. The liquidity used is the max amount of liquidity that a bank uses to make a payment. And the liquidity efficiency is just the amount of total payments in the system per amount of liquidity used. So back to my 2x2 game with Linda, if we both have to send $10 of payments, and I send $10, I use $10 of my liquidity. I posted $10 of collateral at the central bank. She waits for my payments and sends me $10 back. The liquidity efficiency is 2 because she used to recycle liquidity, and it's $20 of payments over $10 of collateral or liquidity. And since coordination matters, we also look at the timing of payments, the dispersion of payments, and the distribution of liquidity through the system. So earlier work, for example, that I did with Morten Becker and Rod Garratt, we looked at the distribution of liquidity in the Canadian system, and we showed that it's not equally distributed throughout the day. So some participants end up with a lot of liquidity, and they could be systemically important because of that. So we construct this Gini coefficient of index of inequality to understand that distribution of liquidity. So these are just in what I just said in equations. P is the amount of payments made through day, where X is the payment from I to J on date S at time T. NT is just like the net level of payments for participant I. So the maximum amount of collateral, a maximum amount of debit position you used, LS, is just how many payments have I sent without the corresponding incoming liquidity to back them up. And then our variable of interest for this exercise is PS over LS, which we denote Q, which is the efficiency of liquidity. Very similar to there's a value, there could be a value judgment and efficiency there. We think of it as it's a measurement. It's like fuel efficiency, right? And then in terms of timing, if you look at the things here, TS is just the average time a day a payment gets made. So that's could be 0.5 is the middle of the payment cycle. So that's just the average timing of payment. DS is the decile of payments. So it's the point of at what time of day is 10% of payments get made in that day, or 50% or 70%. And then this TDiff is a key covariate. And it's basically the difference between the deciles. So if you think of if all the payments get bunched up at the end of the day, so McAndrews and Rajan document this for the Fedwire, everything happens at 4 o'clock. So you'd think that the decile of 20% of the payments made is about 4, and the decile of 80% of payments made is 430. So the difference between them is quite low. So small amounts of TDiff sort of imply high degree of coordination, and high amounts of TDiff imply a low degree of coordination. So here's just some stats for our payment systems. It's a bit ragged in terms of the N, so we have a bit of a ragged sample, and we basically went back as early as possible to cover the financial crisis. So you see all these. Most participants start in 06 or 08, and our last dates are mid 2018. But we're in the middle of updating this sample to to the 20s to 2020. And just to give you a flavor of some of these numbers, right? So if I remember the numbers right, the P is the total amount of payments in LVTS, which is the Canadian system. So that mean is the average daily number of value of payments, which is in US billions of dollars. So about $139 billion get sent through LVTS per day, for example. And L is the sort of the net debit position, so it's about 16 billion. And then Q, the efficiency, it's about $8 per dollar of liquidity. And I'll just highlight one other thing. If you go to Fedwire, or sorry, CHAPS, the Bank of England system, their Q efficiency is higher at 12. So, this is why it's interesting to look at these systems cross systems, because I think when people look individually, the impression was always the Canadian system is very efficient. But when you look across systems in a systemic way, the Canadian system is average because of some of the way it prioritizes liquidity. So I'm running short on time, so I'll just go right to the regression results. And these are charts of the various measures which are in the paper. We also have institutional features. So, for example, and I'll just mention them because they're in the regression specification. Incentives are as if there's an incentive to pay earlier during the day. So the Swiss National Bank system, for example, payments are more expensive later in the day than earlier in the day to ensure this. In the Canadian case, there's a rule that we will look back and see if 50% of the payments get made before noon, for example. LSM is just a dummy variable if there's a liquidity savings mechanism. And the next three, the FIFO bypass, the offsetting, the priority, and the reservations, are just measures of different features of an LSM. So is this FIFO bypass protocol used, which is supposed to be like the best way of, this industry standard way of setting up a queue. The multilateral offsetting is, does the queue net across multiple people at once? Priority means I can just put different prioritizations on payments. So payment one goes before payment two because payment one's really a priority. And the reservation means, can I reserve liquidity outside this LSM to make important payments? And there's a little institutional variation across the sample at a system level. So the UK introduced an LSM, Switzerland introduced this liquidity reservation in sample. So it gave us a little more institutional variation. So I'll skip that for now and get to this result, because I think this table is the number one result, the key result in this paper. And this is a subset of a larger sort of table of panel regression results. So if you look at the first result, where the specification was just the timing of payments and the coordination of payments, you sort of see what you'd expect. As TDiff gets smaller, so coordination increases, efficiency increases, which is what you sort of expect. Then another estimate we looked at is we looked at the different, sort of the memberships, the interbank, overnight interbank rate, is there reserves in the system and whatnot, and is there an LSM? That's just a dummy variable, if there's a queue or not, or if there is one of these things or not. And reserves, again, that makes sense. As reserves go down, efficiency goes up. So as the opportunity cost of liquidity goes down, efficiency goes up. The LSM, on the other hand, is the completely opposite you'd expect. You'd expect the introduction of an LSM to increase efficiency. It's a very strong result, that is, it does not. And then when we look at the individual features, we look at these features and show that really it's, if you go to that level, it's really about this prioritization. So if the system breaks netting results, so this allows coordination due to the institutional features, it's going to reduce efficiency in the system. So I know I'm over time, so I'll skip. This is we looked at these TDiff sort of panel regression of the coordination as a measure of these systems. They sort of make sense as well, but I'll skip that for now and get to the sort of the explanation, right? So, LSM features are, they're associated with earlier payments. A lot of them have no effect on LSM, liquidity savings mechanism features have no effect on coordination, on efficiency, which is surprising. And some of them have negative effects on efficiency. So those are quite surprising results. and for a sample, they're very robust. So, this shows that LSM design can actually reduce efficiency, basically some of it's due to endogenous behavioral changes. So banks change their behavior, and that can undo some of the increased efficiency. And then another secondary result is incentives to pay earlier increase efficiency, which is, again, something else that payment system experts wouldn't have thought was that important. Now, I think going forward, before I yield my time, is if there's any other central bankers in the audience who are not part of this and have this data, please reach out to me to join. I've tried to make it as low overhead to add to this project as possible. And I think it's because it's also important because we have a very small N panel. So, I hope the results aren't due to the fact that we have some sort of small panel. So we need to collect additional data, essentially. And as another sort of a call to action for this group is, we've just finished this project and we're in the midst of trying to think of what another project we could do with this data or this setup. So, if there's interest, if someone has an interesting question, again, and you're in a central bank, feel free to reach out to me, and we can chat and see if there's opportunities for collaboration. And and I think that with that, I'll turn my time back over to the moderator.
All right, thanks, James. We have just a couple of minutes left. Let me open it up for if anyone has questions, feel free to put it in the Q&A or the chat, or if you're a panelist, just jump in. Okay, Eduardo.
Yeah, hi, James. Thanks so much for the presentation. Maybe you did mention it at some point, but could you elaborate on? Did you analyze differences around QE or differences around like new regulations and how that changed since your data set it starts in 2006, I believe. Could you add just maybe a line on that one?
Let's collect a couple of questions. Wait a second. Let's collect a couple and then
sure.
The response together. So any other questions?
Yeah, I have a question related to that. So it's related to Eduardo's question, and thank you for the very interesting presentation. So I was wondering, it sounded like that these interbank payments they need some kind of collateral, like and this collateral, it sounded to me, to my understanding, this is like part of the HQLA, which kind of became important or became was implemented with the liquidity regulation after the global financial crisis. And so my first question is whether there is an overlap or some relationship in this what you are looking at and this HQLA. And the second is maybe more related to what Eduardo said. Do you see some effects of this regulation? For instance, you look at daily data is what I understand, but these requirements, these liquidity requirements, they are to be complied with by end of the month. So an interesting thing to see is whether there's like some intra-month differences in the effects that you find, so that banks act differently when they're moving toward the end of the month and have to comply with the new liquidity regulation. And another point is, so I like that this IBRN idea was kind of adapted, and my understanding is that you worked on the country level, that you used country level data for your estimations, and I was wondering whether it would also be possible to work on the bank level and then country by country, so you see whether the effects also are there on the micro level and whether they are similar across countries or not.
Thank you, Ursula. James, 2 max 3 minutes. I know that's tough, but you could always use the chat and the the Q&A for responses. Go ahead, James.
Okay, thanks. So I'll try to take them in order, and hopefully I don't miss some of the things, because I think some of these just spurred research questions for me. So first, I think in terms of the QE aspect, we have reserves and interbank the overnight rate at a country level, or basically a country level in the regressions, but they're linear. So I think there could be some looking at nonlinear effects, as they get to the floor, right? So I don't think we've done that, but that would be something to double check for robustness. On the HQLA and the liquidity, especially the liquidity requirements, I think that's a fascinating idea because Hamilton has a JP article similar on reserve averaging from like the 90s, where it shows that there's this inter-reserve period averaging for banks behavior. So we hadn't thought of that, and I think that might be interesting, especially because we'll have cross system variation of like how it's measured, right? Because different jurisdictions might have slightly different rules. So that's something to think about. And then, what was your last question? I think. Oh, bank level. Yeah, sorry, bank level. I think that's something we thought about, and I think it's also one of my sort of sneaky reasons to get into this IBRN session is I think getting this work done across systems, it sort of deals with sensitive data, right? Just like the IBRN deals with sensitive bank regulation data. So having some sort of work at the institution level to create statistics that can be put together at a panel level, I think is a natural research question to ask, and it'd be interesting to understand because these payment systems are basically tied directly to the funding markets, right? So it's a view into how funding markets at a system level matter, and I've been beat up in the group a lot because this is not country level, as the European Union ECB people will say. This is a system level. So there's multiple countries in the European Union. So, but yes, I take your point. It's that jurisdictional level that matters.
Yeah, thank you, James. And just in terms of getting questions before the IBRN, we're about to send out our next survey for soliciting different ideas to vet. So speak to your Bank of Canada reps, and thank you for a really clear presentation. So now we're going to turn to Leslie Shen from the Federal Reserve Board. She'll be talking about risk sharing and amplification in the global financial network. So now we're going global cross-border. Take it away, Leslie.
Thank you. Thanks, Linda. I hope you can see my screen.
Yes.
Okay, great. So thanks, Linda, and the conference organizers for giving us the opportunity to present this paper. This is joint work with my colleague, Tony Zhang, who's in the audience. And since we're both at the Federal Reserve, the usual disclaimer applies. This paper is relatively new, so we're very much looking forward to hearing your comments and suggestions. So the starting point of our paper is a central and long-standing question: international finance. How do financial linkages affect international risk sharing and shock propagation? And as many of you know, over the past 2 decades, especially after the global financial crisis, there has been rich literature that points out that global banks, which broadly are banks that conduct cross-border businesses, play a key role in propagating shocks. And this includes a series of work by Linda and others in the audience. So much of the literature uses reduced form analysis to study propagation between a specific country pair. And they usually have this type of framework in mind. And so there are banks in country A that experience some liquidity shock. And the goal is to understand by how much and through what channels do such shocks affect bank or firms in country B. So usually there's some cross-border flows variable that's regressed on the shock variable on the right-hand side, controlling for lender and borrower characteristics. In this paper, we want to take a step back and take note of the fact that the global financial system is highly complex, involving many bilateral relationships between banks and firms of many countries. So more concretely, as shown on the right here, you can think of banks in country A, they could borrow from or lend to banks in country B and C, and vice versa. And banks in country A could also lend to firms in country B or C, and so can banks in country B and C. And there are many more countries in the system, and therefore banks and firms. And the former bank-to-bank interactions make up the global interbank network, and the latter bank-to-non-bank interactions make up the global credit network. So these two networks are two key components of the global financial architecture, as illustrated here using data from the BIS. In this paper, we summarize these two networks as a global financial network. And the key question we want to address is how and by how much does the global financial network affect both risk sharing and shock propagation, both across countries and across sectors? And how we're going to do that is to first properly address this question, we need a model that captures key elements of the global financial network and allows estimations and empirical exercises to quantify its effects. So to that end, we start by constructing a structural model that encompasses both the global interbank network and the global credit network. The model accounts for three key elements in the network. First, banks' decision to allocate their asset portfolio, or specifically bank loan supply, both across countries within networks and across networks. Second, drivers of all bilateral flows, including both cross-border interbank flows and domestic and cross-border credit flows. And third, we account for endogenous prices. And next, we estimate bank supply curves for 20 countries using balance sheet data from the BIS and a set of measures that capture lending prices, risk, and characteristic of the borrowers, lenders, and bilateral relationships. And then we use the estimated network to conduct counterfactual analysis to both dissect how the global financial network affects international propagation of shocks and quantify the amount of risk sharing and amplification through the network. All right, just a preview of the key results that we find. First, we show that the global financial network gives rise to a systemic rebalancing effect. What that means is, in response to negative local or global funding shocks, banks in the network actively reallocate funds across all countries, both within networks and between networks. This effect, which should solely be attributed to the structure of the network, is often conflated with the effect on the actual shock in the existing literature. And our estimates show that this systemic rebalancing make up 42% of total effect in response to a local funding shock. Second, because of this effect, the global financial network improves global risk sharing by providing insurance, especially to countries directly hit by the shock through three margins: interbank rebalancing, global credit rebalancing, and self-credit rebalancing. In particular, the global credit rebalancing absorbs 30% of the negative effect on local non-bank sector funding on average. On the other hand, the network can amplify shocks for countries not directly hit by the shock. Third, we show that the insurance mechanism significantly weakens as the shock increases in scope. So during the global financial crisis, insurance through global credit rebalancing declines by 60%, and self-insurance through the global retrenchment increases by 15%. Okay. Now I'm going to highlight the key components of our structural model. The framework is based on the simple conceptual figure that I show on the first slide. More generally, there are N countries that participate in the global financial network in the model. Each country has a representative bank that allocates its AUM to two potential sectors: the banking sector through the global interbank network, or the non-bank sectors through the global bank to non-bank credit network. In particular, each sector can have N+1 borrowers, with +1 being the outside borrower. You can think of them as destination countries outside of the global financial network. our modeling of banks' loan supply largely built on the recent work by Koige and Yogo on demand-based asset pricing. So in the model, supply of loans will be based on nested logit structure, meaning that the portfolio weight that country N, banking sector, puts in country M, sector L, at time T is made up of a within sector portfolio weight and a cross-sector portfolio weight. The within sector portfolio weight is a logistic function where the delta here in the numerator captures desirability in lending to country M in sector L. And the denominator is the desirability of all potential lending opportunities in that sector. So what is desirability more precisely? It is an exponential function of loan price, characteristics of the borrowers, lenders, and their bilateral relationships, and a latent supply term, kappa, which captures any unobserved characteristics of a loan. And in addition, we not only allow banks to decide whether they want to lend to the US versus Japan, but also to banks versus firms. So this cross-sector portfolio weight is also logistic in structure. The banking sector N's portfolio weight in sector L is going to depend on the total desirability of loans within sector L, as well as some sector-specific fixed effects and a latent supply term. And this term lambda here captures substitution between sectors, and that should fall between 0 and 1. Okay, so a novel element we want to embed in our model is a network structure, which is needed to study its interactions with banks' lending decisions. As shown, the total AUM of the bank sector in each country N in period T here is the sum of funding from domestic sources such as bank deposits, as well as funding from international transfers. And this part is endogenous to assets in the banking sector in each country, as well as a portfolio allocation problem of all banks. So as more capital flows into a country or sector, price will go up, and that will feed back into the amount of AUM in not only this banking sector, but all banks in the network. And this element is novel to existing work, which usually takes AUM in the system as exogenously given. In equilibrium, the prices in the bank and non-bank sectors must satisfy market clearing conditions. So ultimately, what these equations are showing is that the banking sector AUMs and interest rates are endogenous, and they must adjust to make sure that the market value of loans supplied equals to the market value of loan demanded in all sectors. So the nested logit structure of our model yields two convenient estimation equations for loan supply curves. One of the key equations shown here allows us to estimate supply within each sector. It shows that the log ratio of portfolio weight that country N puts in country M, sector L, to the weight in the outside asset is a linear function of loan price, the characteristics of the loan, and the latent supply curve, which naturally falls out as a residual in the regressions. And our main data for the estimation is the BIS locational banking statistics, which is a familiar data source. And this data is uniquely appropriate for our study because it perfectly maps our framework. It includes cross-border and local claims of all banks, domicile in the reporting countries broken down by reporting and counterparty country pairs, as well as by counterparty sector, so banks versus non-banks. And for the characteristic variables, we use characteristics of the borrower, lender, and their bilateral relationships to capture differences in expected returns and risks across countries, including GDP, GDP per capita, inflation, sovereign default probability, stock price volatility, monetary policy rate, an index of macroprudential regulation, as well as bilateral distance, bilateral trade exposures, and exchange rate. And for prices on interbank lending and non-bank lending, we use interbank lending rate and prime rate respectively. Our final sample consists of 20 countries from 2005 to 2019. That includes advanced economies as well as emerging markets. Okay. So if we look again at this estimation equation, you may notice that there likely is an issue of endogeneity. Okay? So higher portfolio share can drive up prices, which will lead to an upward bias of this coefficient on price. And to address this problem, we'll follow literature and use a procedure from Koijin Yogo. In short, what we do is using the structural model to construct a set of implied instruments for price, essentially using the variation in a set of exogenous variables like bilateral distance and own country dummies and lagged GDP to instrument for price across countries and sectors. Ultimately, I'm not going to have time to show the estimation results, but they are sensible. For example, they show that banks supply more loans as expected return increases. And for the rest of the talk, I'm going to discuss results on counterfactual analysis to study how the global financial network contributes to the propagation of shocks using the estimated model.
You have about 8 minutes more.
Okay. So all the results I am going to show today are effects from a negative bank funding shock. You can think of as any exogenous shock or policies that lower the amount of capital banks are willing to use to fund loans, such as more stringent regulation or monetary policy contraction. We'll start by studying the effect of a 1% local bank funding shock in the US on a specific destination country, Turkey, and focusing first on the interbank market. In response to US local funding shock, funding to Turkish banks through the interbank market declines by 0.05% overall. This is in line with the results in the existing literature about how funding shock in financial center can be spilled over to emerging markets. However, what we want to point out is that this total effect can be decomposed into a component that can be directly attributed to the shock and components that should be attributed to the global financial network. So first, what we mean by the shock component here is the change in Turkish bank funding holding all countries' loan portfolio weight fixed. So that change are due to US shock given the ex-ante network structure. This shock is comprised of two parts. The direct part here in orange is a decline in interbank funding directly from the US, and the higher order effects are declines in interbank funding from countries other than the US due to the US shock. In addition to the shock effect, a significant amount of the aggregate effect is due to rebalancing by banks in the global financial network. Banks actively reallocate funds both within the interbank network across countries and across the two networks. So in this case, interbank rebalancing dampens the US funding shock by 20%. So now moving on to look at the effect on non-bank sectors. In aggregate, we estimate that the loan provision to the Turkish non-bank sector declines by 0.06%. This total effect can be decomposed into a shock effect, a rebalancing effect, and a retrenchment effect. As you can see, the shock effect constitutes a small portion of the total decline, and the vast majority of the lending is driven by the rebalancing activities of the global banks. And we further decompose the rebalancing effect by within network rebalancing versus between network rebalancing, as well as by the sources of shock. So the decline in Turkish non-bank funding is mostly driven by non-US banks moving loan supply away from Turkey to take advantage of the unmet demand for loans in the US. And also the reallocation of interbank funding works to slightly amplify the negative effects on funding to the Turkish non-bank sectors. And the third component here, the retrenchment, captures domestic banks' self-rebalancing activity induced by the shock. So these activities reflect the degree of self-insurance provided by each country's own banking sector. So in summary, the global rebalancing here amplifies the shock effect by 2.5 times, and a domestic rebalancing through retrenchment dampens the shock effect by 40%. And these two effects are significantly greater than the shock effect itself, which shows that the effect of the US funding shock on Turkish non-bank sector is mainly driven by foreign banks' endogenous reallocation of funds within and across networks, as well as by Turkish domestic banks' retrenchment of funds from the global financial network. So we summarize these two rebalancing effects as a systemic rebalancing effect. And this effect is normally conflated with the shock effect in the existing literature, and our results show that it can be the dominant force in international propagation of shocks. In addition, what our results reveal is the importance of accounting for all bilateral drivers of loan supply when evaluating international transmission. Existing literature normally controls for a characteristic of origin or the destination countries, but we show that demand from all players in the network can matter. Next, we examine the effects of the same US shock on funding on US itself. So the shock indeed affects the US non-bank sector directly, but due to foreign rebalancing and retrenchment of US banks, that dampens the direct shock by about 70%. So this shows that the global financial network can provide insurance to the country experiencing idiosyncratic shocks and improves global risk sharing. Much of this insurance is provided by banks in other countries in the network. And as we show here, though, the non-bank sectors in the non-shock countries experience amplified effects from the US funding shock because banks provide insurance. If we zoom into the differential effects for advanced versus emerging market economies, we find that the AFEs, they experience more amplified shocks and contribute to global risk sharing because their domestic banks tend to reallocate more funding to the network through negative retrenchment. And the EMEs, they experience more amplified shocks because the foreign banks tend to reallocate away from them in response to the US local funding shock. Okay. So overall, our results match some of the known broad patterns about how global banks can propagate local shocks to banks and firms abroad. But at the same time, we offer new insights on the role of the global financial network in providing insurance, inducing amplified shocks. And the last set of results I'm going to show is based on our analysis about the global financial crisis. We simulate the global financial crisis using observed declines in domestic funding in real data for the US, UK, Germany, France, and Spain in 2008. Sorry, that's a typo, 2008 Q4. So first, to understand the role of the global financial network as the shock becomes more global, we iteratively shock each of the listed banking sectors. As you can see, as more banking sectors in the network experience funding shock, the rebalancing activities decline and capital retrenchment increases. And fewer and fewer banks are willing to reallocate funds abroad. The insurance mechanism in the network gradually breaks down. And here, if we examine the effects of the GFC shock altogether over time, we see that there is significant variation in the insurance provided by the network. Interbank and non-bank sector insurance declines about 60% during the GFC, and self-insurance through retrenchment increases by 15% during that period. So this result echoes the argument in some of the networks literature, like Asmugu, about how the financial networks become less resilient when there is a global crisis. But we arrive at this result using a completely different approach that integrates endogenous interactions among multiple financial networks, where the network literature is mostly based on pure theory and focus on static network. Okay. So I'm going to conclude. In summary, we introduce a new framework that allows a more structured and systematic analysis to understand how the global financial linkages affect international transmission. The model integrates multiple financial networks, assets, countries, and thereby allows a joint analysis of shock propagation, both within and across sectors and countries. we estimate realistic bank supply curves using the framework and tease out some new insights about the connection between financial linkages, international propagation, including the importance of systemic rebalancing, and how global financial network can both enhance risk sharing and amplify shocks. We have a number of steps going on for our next steps in the project, and we're including working on using the estimated model to study other sources of shocks. Thank you.
Thanks, Lizzie, for a great presentation, and also Tony for nice work. I guess I have a couple of questions. One is the role of country characteristics. So, for example, when Nicola Chattarelli and I looked at some of the flows through banks, we found in response to shocks, each bank prioritized important locations for them and withdrew from other locations. So this is your rebalancing kind of feature, but I'm wondering if you can investigate characteristics that are associated with rebalancing away from and characteristics that are associated with rebalancing towards when there's a negative shock. So that was one question. And the other question is just a conceptual question, which is, you know, I think underlying this general equilibrium approach is that this is a closed system, but you also have a lot of non-bank funding providers at this point. So how should we think about the role of non-bank providers coming in when there's a shock to bank providers? And I mentioned that just having looked at BIS data for international debt securities and banks in the COVID period, I observed that the growth rate of international debt securities actually was much stronger during this period than the growth rate of banks. There was a rebalancing from some market share from banks to market-based finance. So just two questions on that. And let me open it up if others want to jump in with questions.
So I'd have a question that is a bit related to Linda's first question to the different country characteristics. The question is whether different kind of shocks have different implications, like whether this, different kind of shocks lead to different reaction of banks and to different behavior. So you can have a liquidity shock, a regulatory shock, economic shock, uncertainty shocks. There's all kinds of different things that can happen in the home country or in the host country. And then if any kind of these many different shocks that we can imagine happens, so where do so countries withdraw, so banks withdraw from the country with a shock, but with which other countries does it lead to a kind of interaction?
Okay, so I will address these questions. So first of all, thanks a lot for the questions. First of all, to Linda's question about country characteristics, whether that's related to rebalancing to and away, and that's something definitely that we could explore further. Currently in our setup, our country characteristics are used to to estimate our bank supply curves. So we take into account, the different country characteristics that's usually mentioned in the literature about the attractiveness of the locations and factors that can affect whether banks is willing to supply funds or not into our estimation to come up with realistic supply curve estimates. And I think what you're getting at is you then relating back to the country characteristic after using our results. So we could certainly do that. Like once we see from our exercises, we can see, given the shock, which countries tend to move away from certain countries, which countries tend to move their funds into certain countries. Then we can certainly relate these results to the country characteristics ex post and to see the relationships there. So that's something that we certainly can do. And then following up on the question about that from Ursula about about different shocks. So I think one of the main benefits of this model is that we can study, multiple various shocks coming from various sources. We can study regulation shock or even any shocks from our country characteristics list, and to see if they have differential effects from just a bank liquidity shock. And that is something that we plan to do next. And the model is flexible enough to allow us to use a framework to do systemic comparisons of the outcomes from different shocks. And then to Linda's second question about outside sources of rebalancing. So right now, it's a closed, we have a closed network. It's all about reallocation activities within the network. So one way to think about it is think of it as an outside additional source of funding, additional source of shock that may affect certain activity in the system, and we then can use the model to see how what are the effects within the system as a result of outside sources. But more generally, I think the model, the general framework of thinking about how different financial sectors, including banks and perhaps non-banks, can allocate their assets across different countries and sectors, the model can be expanded to include an additional sector, such as debt or even equity. And there has been work that have been done to incorporate multiple sectors, multiple financial sectors to study the sources. So that model could be expanded to study it. Yeah.
Okay. Thank you very much for this really nice work. And on the issue of global banks, we'll turn to global systemically important banks and how they lower capital surcharges. And Marcelo is going to present. So Marcelo. It looks like we have lost Marcelo. Let's jump to Eduardo while Marcelo comes back on. Eduardo will speak on exports of financial services in the internet era. Thank you, Eduardo. You are muted, Eduardo.
Sorry about that. Can you see my slides? I hope they I hope you can see them and that they are somehow moving.
Yes.
Okay, let me just take track of time. Okay, so hello everyone. My name is Eduardo Chiarotti. I'm a PhD candidate international economics at the Garratt Institute of Geneva, and I'm also a visiting student at the London School of Economics and academic visitor at the Bank of England. And today I'll present a paper that is titled Export of Financial Services in the Internet Era. We're still working on the title a bit, but for now it's that one. And this paper is co-authored with Stella Rubinova, who is an economist at the OECD. I'm going to try to keep the presentation under around 20 minutes, so we have some questions at the end. And before I start, let me just thank Linda and Ursula and IBRN for the opportunity to present at this session. So what is the paper about? So in broad terms, well, the paper, yes, it's about infrastructure and the internet. And so how banks use this internet infrastructure to reach clients in foreign countries. And so that's more or less sums up into the decision on whether doing, foreign direct investment or direct export, that has been addressed several times in the literature and summarized by Oldensky in 2012. And she sort of pointed out that the core of this trade-off stays in these different types of communications that the banks face. So they can be summarized in two groups. There's a client communication, which is during delivery or sales, or within third communication, which is during production. And when we think of the banking sector, where in the banking sector, client communication is really key, right? So individuals prefer or need to go in person to open a bank account, for example, or banks find it easier to grant loans to firms that are located in their same geographical area. So proximity is really key. And that's why, as you all know, banks do mostly FDI to enter a foreign market, right? So that's how was it mostly, or how it still is. But so since 2000, we do see a sharp increase in banks' cross-border positions from this BIS dataset that we also just saw from Leslie's presentation. We do see an increase in cross-border positions since 2000, and so maybe the internet played a role in moving the balance a bit from a prevalent foreign affiliate approach to a more cross-border approach, which leads us to ask ourselves whether internet has contributed to the research increase in cross-border positions. You can think of it as internet banking. I'm going to give you the intuition about that in a second. So this is an empirical paper. What we do is we combine data on cross-border and foreign affiliate positions by the BIS. The cross-border position will be the main variable here, and that's from the locational banking statistics of the BIS, which we just saw in the former presentation. And we merge it with this data on submarine cables that we have that connect countries. And so since we do that, then we can use this very standard gravity framework that is used very much in the trade literature, but is also being used in the recent literature on international banking. And so what we do find quickly is that we do find a cable connection boosts these cross-border positions, while there's little effect on foreign affiliate positions. And also we do find that for cross-border positions, it takes about 4.5 cables to defy distance. We'll see what that means. And also, yes, we have a set of checks, and one of them is we run these regressions in a subsample of what we can call routing cables. We'll see what that is, but that's about identification because it could be a reverse causality issue. So we'll see what that's about. And then finally, we try to kind of address the channels behind these results and what's driving them. And for example, we do find that the effect of cables, well, first of all, is present for both loans and deposits. We can disentangle between those two thanks to the BIS statistics, but also it's especially true when the banking sector in destination countries is small and unstable. Yeah. So the intuition of that is, people in Indonesia would use the internet to open a bank account in the US, while Swiss people would not do that because they're already happy with their banking system at home. So that's a bit the intuition, and we'll see about that a bit later. So that's the slide on stylized sparks. So these are what we call export generating positions, right? And what are those ones? So I think you're familiar with this BIS locational banking statistics about claims and liabilities of cross-border claims and liabilities. And these export generating positions are the positions which we can take from this data set, for which we are absolutely sure or almost sure that they generate an export. And that would be the loan component of claims to non-banks, which are claims to firms and individuals, and the deposit component of liabilities to non-banks, which would be the deposits, right? And these are stocks. So for those two elements, we can be sure that those ones are loaned to firms, for example, that generate a fee or an interest rate, and therefore generate an export. And also the liabilities these deposits are for sure deposits to either individual and firms, which are again a fee for the exporting bank, right? And so that's why we focus on these two main positions. And what you can see is that loans, for example, the brighter blue, they kept increasing from 1995, and that's also true after the financial crisis. So also the title of this session is a bit integration and fragmentation of global banking. If you observe other BIS statistics, you'll see that there's been a decrease after the crisis of positions. So somehow deglobalization. Well, that's not really true for if we just stick to the loan. So that's and internet and internet banking could help banks in home countries to reach firms in foreign countries. So internet could play a role about that, and also for deposits. Yeah, same principle, right? So anyways, that's a bit what we're seeing. And what I plotted here is the network that we have, just to give you an idea of the major sort of exporters of financial services. And they are, you see the United Kingdom, United States are, of course, the big ones, and they trade also a lot with each other. And then, of course, there are the tax havens that are present also in this data set. So what about, so that's the kind of position data that we're going to be using. And then we match it with internet cables. So we take internet cables as a proxy for internet, if you wish. These are fast internet cables, and since 1990 they started to grow quite a lot. So this map just plots the evolution over time. You see that already in 2000 they started to be quite some of them, and then if we move to 2010 and 2020, you just see that this network just becomes bigger and bigger. And so that's the kind of variation that we exploit in our paper. To try to see if internet measures as a number of internet connections through submarine cables plays a role in driving banks' cross-border loans or deposits. Right. So just again very quickly to pin down what we're doing conceptually. So you can think of a world of where there's no cable connection. There's a headquarter that meets the need of client communication, mostly with foreign affiliates, right? As we said at the beginning. And in this world, yes, there can be an issue of within firm communication for non-routine tasks, for example. So credit scoring for loans or portfolio management decisions that the headquarter may want to share with the foreign affiliates abroad. Now, if there is a cable connection coming in, now the headquarter can meet client communication not with foreign affiliates anymore or less, but just with the internet. And this boosts cross-border exports, right? So think of it as home banking, and people in the UK can use home banking to open a bank account with a bank in the US, or firms in the UK can get a loan from a bank in the US and checking it through home banking. So that boosts cross-border exports, and it can also help within firm communication, because you can share more information and so on. Of course, that could be done also through the phone or emails. So we do expect there can be an effect also on foreign affiliate position. That's the bottom line of this line, but less. Think of it this way. Right, there's the literature. I'm not going to say too much into this one, but there are some papers. So that's the takeaway of this slide. And we can come back to it a bit later. And I'm just gonna, quickly, while there is quite a large literature, we do believe that we contribute in some way, making it more general for sure. And by merging this data, and these are the main advantages of using the data that we use. So we can come back to it later if you have any questions about it. And again, the data, since we already talked about it, I'm not going to say too much on this one. It's BIS statistics. It's for the cross-border, again, export generating positions, which is this sum between these loans and deposits that we've seen. and that's the locational banking statistics. And we also use the consolidated banking statistics for foreign affiliate positions in some results where we compare the two, because we expect less of an effect of the internet on foreign affiliate positions. We also compare it with expert variables that are correlated with the BIS statistics. And then anyways, the summary in cables is from telegeography, and we have the gravity variables, and then we have variables for the banking sector at the country level. Right. Again, summary statistics. I'm not going to say too much of this one. This is just a very quick sketch of the model. It's just a really simple gravity equation in which cables enter as a FTI dummy, for example. So cables can be also zero, and so that kind of allows us to keep the zero sort of cable observations in our model, and the X would be these BIS positions, and we also control for manufacturing trade as the literature does, because that could be driving the position. So right, let's jump directly into the results. So that's our baseline table. What we have on the left-hand side is this cross-border positions, which is the sum between loans and deposits. And on the right-hand side, we start by including distance, and there's a set of controls that are not reported in this slide. So what you can see from column 1 is the difference has a negative effect on cross-border positions in general. Yes, before I move on with the table, let me just tell you that we focus on post-2010 sample, because we believe that post-2010 is where the whole home banking logic started to happen, while before not very much. And so we start with a very kind of standard approach, and we aggregate our time dimension, we collapse it, and then we just have an origin and destination data set. So bear that in mind, right? And so in this data set, you see the distance has a negative effect. Now that effect gets cut in half when we control for manufacturing trade, as it shows in column 2. And then when we include cables, it still decreases a bit, not that much though. But the key result is that you see that positive coefficient of cables. So that is telling you the countries that have more cable connections or more internet, then they trade more in cross-border positions. So, for example, there's going to be a lot of United States banks giving loans to firms in the UK through the internet. So that's in theory what that's telling you. And what we also do is that we interact with distance, and what that positive coefficient in column 4 is telling you is that it takes about 4.5 cables to reduce to kill distance in our regression. And what column 5 and 6 are doing is the same thing, just with this more of an extensive margin, if you wish. So in that one, we substitute all the missing observations of the BIS data with zeros, and we use this Poisson pseudo maximum likelihood estimator, which is used in the trade literature for gravity equations, and you see that we obtain more or less the same results, right? And we also have a comparison with foreign affiliates. Now this one has all the caveats of merging two different data sets from the BIS. One is the locational banking statistics, and the other one is the consolidated banking statistics, which have different accounting principles. So bear that in mind, but we do that nonetheless, and focus on column 6 and 8, for example. What you can see is that the coefficient for column 6 on cables on foreign affiliates is not statistically significant, and that suggests that while internet works for simulating cross-border positions, it does not or not as much in simulating foreign affiliate positions. So banks may use the emails or phones to share the information they need to share with the foreign affiliates, but not fast internet. That's the message of this slide. Right. We run a set of checks. I'm not going to say too much on this one. We have also nonlinearity of cables regression. So that tells you that more or less when you're connected with one cable, you that does the job for cross-border positions. So there's not much of a difference if you have 2, 3, 4, 5 cables. But still, there is this nonlinear impact of distance, right? So while it's true that one cable does the job, still more cables helps decreasing distance, if not kill it, around 4.5 cables. So that's the message. We also have a table of impact through time, and then we also run some panel gravity regressions in which we also plug in the time dimension. Since we have data from 1950, that's very nice. You know, there can be a reverse causality issues because you may think the countries that trade a lot or have a lot of positions, they also finance these cables. And so, yeah, we start addressing that with the lags of cables in a panel setup. And the only thing we do for reverse causality, which is what I wanted to kind of draw your attention on and get your reaction, is that we run the model in what's called a routing sample. So I'm just going to give you the quick intuition about that one. So what's a routing cable or a routing connection? A routing connection is a connection that a country gets simply because it happens to be on the shortest sea distance between the two other countries that are financing the cable, right? So you can think of Egypt, for example. So Egypt is on the Suez Canal, and you know, on the Suez Canal, there's going to be a lot of cable passing through from European countries that want to connect with Asian countries, right? And Egypt just happens to be there, and therefore gets these cables are very long, so they need to stop in Egypt to then go on the Indian Ocean and so on. And so Egypt gets a connection, but is not financing it somehow. And so what we do in this routing subsample is that we identify countries that are along the Suez Canal and then the Indian Oceans that you know can get connections from cables financed by the Europeans and well, the Chinese, for example. And what we do, well, this is a subsample, so it's smaller, so we have to just use the panel regression and then use dummies for more power. And we have a cables dummy, which is a general, again, dummy 0-1 if there is a connection or not among these countries, and then we see the positions of these countries with either Europeans or Asian countries. Yeah. And also we have an alternative called cable dummy routing, in which we just focus on 4 cables that the literature points out to be only financed by the European and the Chinese. And so we get more or less the same results of the other sample, which is encouraging. We can come back to this later if you have questions. And then the final table of today is about the channels. So we try to see what drives our results. And first of all, we disentangle, thanks to the BS statistics, we can disentangle between loans and deposits. And we do find an effect for both. So think of it as, you know, Indonesian firms getting a loan from a US bank, or Indonesians opening a bank account with a US bank and get a deposit over there. So that would be column 2. And then what we also do is I mentioned Indonesia because as mentioned at the beginning, it doesn't have a developed banking system as Switzerland does, for example. And so that we believe that internet can play a role in helping Indonesians, for example, to open a bank account, but not very much the Swiss, because the Swiss, they have a very developed bank account banking system at home. And that's what coefficient, for example, in cable 4 of the assets of the cables, you know, when we interacted with asset size of the banking sector in destination countries, or the Z-score for stability in destination countries are telling you. So the impact of cables is lower when the assets, when the bank size in destination countries is bigger, like for Switzerland, for example. And then 7 and 8, we run the PPML regressions, and then we get these significant coefficients both for the size of the banking sector and also the stability of the banking sector. So that's about it. So just to wrap it up, we combine data on cross-border positions by the BIS and number of submarine cables, connect country pairs, and we use a gravity framework to study the impact of internet on cross-border positions. We do find that cable connection boosts cross-border positions, while it has little effect on foreign affiliate positions, and it takes about 4.5 cables to the 5 distance. And we also ran a set of results also with this routing subsample to try to address indigeneity. And then we also find that this effect of cables is present for both loans and deposits, especially when the banking sector in destination countries is small and unstable. So that's it from my side, and thanks very much for your attention.
Thanks, Eduardo, for a really nice presentation. This reminds me of early work by Portis and Ray, and kind of, you know, an upgraded version of that, up-to-date version of that. I guess we'll collect questions now. One question I have, and let's collect them and then you answer. One question I have is the mechanism. And so when you're thinking about, you know, like if we want to take general lessons from this, we have a specific lesson about cables. But the specific lesson about cables won't be an experiment or a policy relevant thing for cross-border banking per se. Do you take cables as a proxy for information costs? Do you have it as a proxy for financial frictions, information flow? What should we take away from a broader perspective, since we're not going to be able to kind of change the structure of global banking and trade as policymakers through, you know, laying cables? I don't mean that in a facetious way, but, you know. So,
no, yeah.
Okay, and let's collect other questions.
So thank you very much. It was a very nice presentation. I've one small question, and this is related to, so you find that there's more cross-border lending when there is more cables, and this particularly happens after the global financial crisis. And what I'm wondering is whether maybe the global financial crisis is an event that changed kind of bank strategy. So I wonder whether banks substitute their lending of foreign affiliates by cross-border lending. So do they reduce their foreign affiliates where the numbers increased a lot before the global financial crisis, or do they just add it on top? So do they keep their international affiliate structures and just kind of change their strategy or use the new possibilities, the communication possibilities that they have in order to grant the loans differently? So what's the trend of the foreign affiliate lending that goes along with that? Thank you.
Should I? Okay, I'm just going to answer to those ones. So to Linda's question, yes, I think so. It's open. I think it's an open question. We can see it as information cost that these internet cables are sort of reducing. And again, I'm not sure whether the paper is the policy sort of recommendation paper. It's more of I guess a description of how banks are changing their business, and then that's just to acknowledge that's a fact, and so that maybe we'll see much more cross-border banking now than we've seen in the past, and so maybe that's also where kind of regulators should focus on. So I think that's a bit the spirit of the paper. And yeah, of course, we cannot invest. Well, yeah, central banks cannot invest in cable structure infrastructure, but the government can. So yeah, so maybe there's also a point has been risen, and you know, also with all this climate change topic and changes that are going on. You know, also with natural disasters, if you have, you know, if you can do banking through the internet, then that's good. I guess so. That's also maybe another interesting perspective that to think about. And I guess the paper is going in that direction. I hope I answered your question. But and so about the financial crisis. So yeah. So if you look at this BIS statistics, I can tell you about the BIS statistics. So if you look at them, and there's also a paper by Macaulay et al., I think is a 2021 paper. They show that there is a general decrease in all positions, both cross-border and foreign affiliates after the financial crisis. So that's what stems out from the data. So I'm not sure whether the banks, whether the financial crisis led banks to change their policy from cross-border to foreign affiliates. What we see in aggregate is that everything decreases. But then the argument of the paper is that that's just driven by some European banks, and that's because of regulation. So that's what I can tell you, what the literature tells you. And if I plot, again, foreign affiliated cross-border from the consolidated banking statistics, which is the other data set, you see a decrease everywhere. So I'm not sure whether the crisis triggered any substitution effect. You don't see it in aggregate. It could be, but you don't see it in aggregate. And what we were expecting maybe also to find is that the internet triggers some substitution effect from foreign affiliates to cross-border lending, but that's not the case, at least from the data, at least from the results that we have. So we don't see much of a substitution going on. We just see possible support of cross-border positions and not much on the foreign affiliates. But bear in mind that has the caveat of the difference in the data set. So it's very difficult to compare different accounting systems. So bear that in mind.
We also had a question, Eduardo, from Tony Zhang, which is that cable building seems highly endogenous. There's probably a lot of negotiations between countries. Was there a moment in history when a country got connected by cable more exogenously? So can you do a different kind of experiment design?
So thanks very much for your question. So there is endogeneity, and that's why we also run regressions with lags, and we also do this routing sample regressions in which we try to address that. I'm not aware of a moment in time. I can tell you that we could do this more extensively by building an instrument, as it's done in other similar papers, and that would be really going through every cable. There are about 450 cables out there, and trying to understand which one of those ones is a routing cable for which country and which one is not, because at least the information who's financing these cables are available. So we could do that. Another source of exogeneity that we could exploit that we didn't do yet are these blackouts. So there is a legend of sharks hitting this cable. This is more of a legend than actual reality. But what does happen is that there are blackouts, and so these cables stop working. Now the BIS statistic is quarterly, so it's not daily statistics. So we could see from one quarter to another what happened where there was a cable blackout. So maybe that could be an exogenous source of variation that we could explore. So these are the things that come to mind.
I was actually going to ask you about the sharks.
That's always get asked.
I didn't know it was legend. I thought it was a really cool fact or factoid. Good to know I'm not spreading falsehoods. There's other work as well that's not on the cables, but information transmitted through the air where the exogenous variation is from the weather. So I wonder if there's anything that, is the equivalent of moisture density or cloud cover from the other literatures that could be applied here, but that's for future discussions. Nice job, Eduardo, presenting. And nice work.
Thank you.
We're going to move on to our last presentation, Marcelo, on how do global systemically important banks lower capital surcharges. So hopefully the transition works, and I'm here as a backup if you need me.
Hello. Can you hear me? Can you see my screen?
There we
okay.
Yep.
Thank you very much. Thank you for accommodating my technical issues. So this paper asks the following question: how the global systemically important banks lower capital surcharges. It is co-authored with Jared Berry and Akbar Khan, and the views in this paper do not represent those of the Federal Reserve Board or the staff of the Federal Reserve System. So the big picture question we ask is about a trend in banking regulation that we've observed over time. So in recent years, some countries introduced capital surcharges on global systemically important banks, the G-SIBs. And these G-SIB surcharges are a major innovation in regulation because risk-based capital regulation traditionally incentivized banks to reduce risk. That is, it required banks to hold more capital if they held riskier assets. And these surcharges, they penalize banks with large systemic footprints. So they motivate banks to lower their systemic footprints. Now, G-SIB surcharges may promote financial stability because they require G-SIBs to hold more capital, but they may also harm the economy because banks may limit their activities. For instance, they can restrict the amount of credit that they supply in order to keep their systemic footprint low. And what do we specifically do in this paper? We examine how the US G-SIBs adjust their systemic importance indicators to lower surcharges. These surcharges, they increase with indicators measured at year end in the fourth quarter. And therefore, the G-SIBs should try to lower their indicators at year end to reduce their surcharges. So from here, you can already imagine what we will do in the paper. We will test whether the G-SIBs lower indicators in the fourth quarter. And also the empirical strategy, I think you've already guessed. We're going to compare G-SIBs, non-G-SIBs. We're going to compare fourth quarter data with data from other quarters. And we're also going to use the timing of the introduction of surcharges. They were introduced in 2016 to identify this change, this difference in behavior of G-SIBs versus non-G-SIBs. So in this presentation, I want to give some institutional information on the capital surcharges, and I'll be very brief on the results. So first, how do capital surcharges work in the US? So the Fed takes the sample of banks with total assets above $100 billion and collects data from these banks using the relatively new schedule called the FRY15, which is public. All the data in this paper are public. And based on systemic importance indicators that banks report in this schedule, the Fed calculates a method 1 score. And here you can see in this table, there are 12 systemic importance indicators that are grouped into 5 categories of indicators. The categories are size, interconnectedness, substitutability, complexity, and cross-jurisdictional activity. And the method 1 score is a weighted sum of these 12 indicators. It's a linear function and the weighted sum of the 12 indicators. So then the Fed takes the score of each bank, and if it's above 130, it will say, well, this bank is a G-SIB. And if the bank is a G-SIB, then it will calculate also the method 2 score, which uses the same indicators as the method 1 score, but substitutes the substitutability indicators with an indicator of short-term wholesale funding. So this method 2 score is something specific to the US, and the Fed decided to include short-term wholesale funding in the G-SIB framework because of the relevance of this type of funding for the failures of Lehman and Bear Stearns and other banks. So based on these scores, the method one score, method one surcharge is assigned, and you can see the mapping of the score to the surcharge in this table. And the same thing happens to the method two score. Now, the important thing about these two surcharges is that the Fed will take the higher of the two, but generally the method two surcharge dominates the method one score, the method one surcharge. So in practice, the method two score determines the surcharge, even though, again, the method one score is alone determines whether a bank is a GSIB. Now, if you go to the bottom balloon here in this figure, you see that the surcharge is a percentage of capital that is added to the minimum requirement for three risk-based capital requirements: the CET1 risk-based capital ratio, the Tier 1, and the total capital ratio. Regarding the timing, the final rule in the US for the GSIB framework was approved in the second half of 2015, and surcharges started being imposed in 2016. They were imposed gradually, and in 2019 they reached the fully phased-in levels. And one thing that is important is that the surcharges in a given year are a function of the data as of 2 years before at the year end, 2 years before. So the surcharge that a bank will be subject to in 2018 is a function of the data reported as of the fourth quarter of 2016, for example. Now, how can banks lower their scores? There are many strategies that banks may follow. I'm going to talk about two that are commonly mentioned. One is the OTC derivatives compression. So OTC derivatives compression is an exercise that different counterparties, you can say different banks, do in order to reduce the notional amount of OTC derivatives. So these counterparties, they submit their contracts to a firm, a vendor, that will take those contracts and reduce them to it will attempt to reduce those contracts to the minimum notional amount that keeps participants' net positions unchanged. And so the advantages is that this exercise, of course, keeps the economics unchanged, keeps the net positions unchanged. Notional amounts of OTC derivatives have a large weight on surcharges, and it's a very quick operation, which banks can do very close to year end. So, another commonly mentioned strategy is repo termination. It's simply stop doing repo, which are repo, they don't have a systemic importance indicator dedicated to them, but they appear in 4 different indicators: the interfinancial system assets, interfinancial system liabilities, cross-jurisdictional assets and liabilities. So it's harder to see the role of repos in the systemic importance indicators, but they have a big weight in the score and surcharges of banks. And again, this is something that can be done very close to year end and resumed shortly after. So our data and empirical framework, the main innovation in this paper is that we use the FR-Y15 data, which carries the systemic importance indicators, and using those indicators, we calculate the scores. We also supplement these data with regular bank characteristics from the Y9C, the bank holding company regulatory report, and we restrict the sample to banks with 100 billion of assets or more, which are those that can be considered a GSIB, and that change the reporting entity over time. So this is the sample that we work with. We have the 8 US G-SIBs, Bank of America, Bank of New York Mellon, Citigroup, Goldman Sachs, JP Morgan Chase, Morgan Stanley, State Street, and Wells Fargo, and 20 non-G-SIBs. Actually, we now have 19 because, as you can see in this slide, BB&T and SunTrust, they merged and became Truist. So here is a chart showing the average Method 1 score for non-G-SIBs and G-SIBs normalized to their values at the end of 2013. And what you can see is that at the end of each year, G-SIBs appear to lower their scores relative to non-G-SIBs more. And the same thing, maybe even clearer, can be seen here in this chart for Method 2 scores. You see that there's a wedge here that opens during the year but closes when banks closes in the fourth quarter. And this is what we estimate in the paper. So our empirical strategy, the main results are a differences in differences exercise in which you compare G-SIBs versus non-G-SIBs in fourth quarters to other quarters. And the dependent variables are scores and systemic importance indicators. We also have in the paper a triple differences exercise in which we also exploit the difference before and after introduction of surcharges, but I'm not gonna show the results here in the sake of brevity. So this is the equation that we estimate, the differences in differences equation, and we're interested in this term here in red, which is a sum of interaction terms between an indicator of whether a bank is a G-SIB and an indicator of the quarter. So actually the coefficient, the parameter we're mainly interested is the beta 4, which is the coefficient for the interaction term between being a G-SIB and being in the fourth quarter. And it should be negative because surcharges are determined by scores measured in the fourth quarter, and G-SIBs should have a stronger incentive to lower their scores and indicators those quarters relative to non-G-SIBs. This is the main hypothesis we'll estimate in the paper. So let me show you the results. This is a table with 12 columns. In columns 1 to 6, we use the Method 1 score as a dependent variable, and in columns 7 to 12, we use the Method 2 score. As you can see, the only coefficient that is statistically significant in this table is the coefficient for the interaction term between the G-SIB indicator and the fourth quarter indicator. In columns 5 and 6, the minus 0.043 estimate indicates that in the fourth quarter, G-SIBs lowered their Method 1 scores more than non-G-SIBs by 4%. And the results in columns 11 and 12 indicate that the Method 2 score is lowered between 2 and 3% in the fourth quarter. So the next question is, where is this reduction in scores coming from? So here I'm showing you with a chart. I think it's easier to see the chart than a table. What the estimates look like when we use the specific systemic importance indicators as dependent variables. As you can see, there's this big drop in red, shows the effects on over-the-counter derivatives. So this is the only specification in which the beta 4 is statistically significant, and it suggests that the reduction in over-the-counter derivatives is responsible for a big chunk of the changes in scores that we found in the previous table. So in conclusion, the G-SIBs lowered their scores in the fourth quarter to reduce their charges. This effect is concentrated in one indicator, which is the notional amount of OTC derivatives. And our takeaways are that banks respond to incentives to reduce systemic footprint. But this is very important. This is not the regular message that you would observe following some evidence from window dressing. This is in line with the objectives of the surcharges. So the regulators, they wanted banks to lower their systemic importance when they imposed this surcharge. What may not be intentional is that the response was unevenly distributed across indicators. It is very concentrated in a single one. Now, banks appear to avoid disruptions to their activities. So they managed to lower their surcharges in the fourth quarter, but it does not appear to cause any problems in market activity. Thank you very much.
Thank you very much, Marcelo. Let me open that up for questions from participants.
Maybe I can quickly jump in. Thanks, Marcelo, for the very nice presentation. It's a very nice paper. I was just wondering, these three charges that you have, are these bank level? And therefore, can you, is it like a capital requirement? I'm sorry, I'm not familiar with what those are. And then, so if yes, maybe a local projection. Have you thought of a local projection with a shock in those three charges? But maybe this is pointless because they're just something happening all at the same time. So, and then secondly, I didn't see I saw the derivatives stuff. Was there a lending? Can banks cut lending to change their systemic risk indicators? Thank you.
Let me build on Eduardo's comment. A very interesting result about cutting OTC derivative positions on the books anyway. But then you mentioned that there's a vendor, banks use vendors to kind of repackage what they have, seeming to artificially, temporarily, perhaps, make these positions look smaller. And, I guess a natural question from that is, does market functioning actually change, OTC market functioning change with this? Or is it just a cosmetic thing, that ties into the way that regulators look at and measure the derivative positions?
If I could ask a question. So you mentioned that the rule doesn't seem to disrupt activities by banks. I was wondering if you could expand a bit on that. Like, have you looked at, perhaps banks' repo activities during year end, where they seem to potentially been affected by these rules, and whether that have any significant effects? Thanks.
Okay, so if there are...
Go ahead, Ursula.
Are there any other questions?
Yeah, I have a very small question. One thing I was wondering is whether these OTC derivative positions, whether this is something that is unique to the G-SIBs in the US. Because when I think about the German banking system, this is something that is like unique to our G-SIB.
Okay, so let me start answering questions. I'm gonna answer them in order. So Eduardo asked about capital surcharges, and so they are collected, the data are collected, and the surcharges are imposed at the bank level. So it's a good feature that we have, that they vary over time and across banks, but they are imposed. It's a single value for the three different capital requirements and for the bank as a whole. Regarding the effects on lending, I actually have another paper in which I use low and level data and show that the G-SIB surcharges do restrict lending. So my take from my two papers is that if you may find some other results if you use more granular data. And I encourage people to do that. Linda's question about vendors repackaging. Yeah, so what generally happens, let's say that a bank decides to bet that the dollar will fall, and if it decides to lower its position, instead of undoing its positions, what participants generally do is they write other contracts. And so what compression does is to simply substitute contracts with a smaller set of contracts that has a lower notional amount in total. And so in some sense, yes, you're right. This is kind of a cosmetic change. It changes the notional amount, which you can argue that also benefits the bank because it reduces the operational risk for the bank, but fundamentally the net positions of the banks should be unchanged with compression. Leslie asked about disruption of activity. Again, I am convinced that you may find more effects of these surcharges if you work with more granular data. So here in this paper, we're working with bank level data. Probably you may find some effects if you work with bank level data or contract level data on OTC derivatives and repo. The problem is that it's very hard to get data on OTC derivative contracts. I'm trying to get that because I think it's a next step that may give different results on the effects of surcharges. And Ursula's question about the specificity of these results to the US. I think that actually some of the hypotheses that we test in this paper are based on specific features of the US rule. So there is already this dimension of difference. Also, I think it's important to mention this. My paper is one of the 3 different papers that examine this question. So there are 2 papers using data from the European Union, and there are some differences in the results. This finding that I have of a specific a concentration of the effort in OTC derivatives is not as pronounced in the other papers. So you can, if you look at my paper, you see the references to those other 2 papers, which use a very similar framework, address a similar question, and one of them was distributed to the public before mine. So I need to acknowledge that too.
Okay.
Thank you very much.
Thank you, Marcelo, and thank you everybody for participating. This was I learned a lot. High quality work, just fits very nicely together. Wish you a nice day and stay safe. See you soon.
Thank you.
Thank you.
Thank you very much.